I don't know. But they help you on the final project, too, because when you do miss things, you get some feedback, too, on what you're missing, or you ask questions, or I tell you dumb things like, the problem's wrong, you know. So, that one had me going for a while, because I'm just like, where are they getting $2,500? I mean, I printed the problem, I did everything trying to figure out where, and I'm like, it's just wrong, you know, because for a while I'm wrong, is what I'm assuming, and I'm like, nope, it's not me, it's the you and a lot of people. That was a very common answer. I kept emailing. Taxes are capped at $10,000. The other common mistake on the practice problem was you did the correct itemized deductions, but then you didn't take the standard deduction because it was more. Yeah, you answered the right answer for itemized deductions, but then when you did it on the tax, you took itemized deduction. Or another problem was some people put the standard deduction on the itemized deduction answer. Even though you knew you took it, you still they wanted what was itemized deductions. On the Schedule A, they wanted to know what it was, even though you didn't take it. So there were a few things wrong. One individual didn't answer the very first question. I think they just missed it. So I think I ended up putting like 14.75 because you still didn't get it right. You know, you missed a problem, but I can't remember who that was. Was that probably you? I try not to look at who I'm doing because I don't like to know because I don't want to be like, oh, man, you know. So I just try to go through and convert the grade. And I round up for the most part, you know, so if it's a 14 point, I don't like 14.6s or, you know, or 8.6s. It's either 5 or 7.5. Normally I don't even do 7.5s, but I was not going to knock that down to a 14.5 because you didn't put married filing jointly. So I was trying to be nice on that one. So there'll be another one of those. There'll be another one of those. And then those, like I said, I think they really help to do the final project. And the final project's just like that. You'll get as many times as you want. So some of you, I've had people that turn in the final project with a C and they're done quick. And they're just like happy to be done with it, and that's fine. And I have other people that will do it. I can go out there and see how many times you submit it because they want to get the A, you know, and so it's really, it's up to you a lot of times. I don't like to see one submission and get a C, but I've also had people submit it with a D and did it one time. And there's not a lot of sympathy, you know, when I go to do grades and you end up with a D and you submit it at one time, because to me you can do that as many times as you want.
Check my work first.
Oh yeah,
right?
yeah.
But the
Can you see check my work?
Huh?
Can you see check my work?
I can.
I hit that thing.
I can limit it too, but I'm nice. I don't do that because to me, the whole purpose of check my work in a class like tax is to see if you're right.
I literally do the first problem, check my work, even if I know it's right.
Because
You can't. I do not want to go all the way to the bottom and then find out where I messed up.
Right. If you do it by form, I don't have a problem. Okay. Okay. If you do it by line, I have a problem with by line. But if you at least try to do the form and then go back and do check my work. Because otherwise you're doing a little bit of analysis paralysis on that one, okay? You got to try to see if you know what you know.
I'll shoot for that next time.
Try to shoot for that.
You know, dividends is wrong, and so you have to hit it 1,000 times just to figure out, wait, there's just something not right here.
But you want to try to do it by form. You want to try to see what you know, and you want to try to test yourself a little bit. If you're doing it every time by line, then you're not even giving yourself the benefit of trying to make sure you know what you know.
Judge-free zone, though, right?
Huh?
Judge-free zone.
Judge-free zone. I'm not there. I don't go in to check my work. I usually go in to submit. How many times you submit and grade.
I typically only do that once.
That's okay. Hey, I'd rather see you try to submit it 45 times and grade it than do it once. So. Yeah. Okay, so this chapter, like I said, I kind of started off by saying it's kind of boring, but we are going to do what we did last week, and I say boring only because these things do happen. They do appear on a typical schedule, a 1040 that you guys would do, but they're on more of an advanced one. They're not going to be on your everyday 1040 that you're going to do. We're going to jump to the end, like we did last week, and then we're going to come back again. I actually have two problems that we're going to do regardless, because some of the stuff that's at the beginning is stuff you'll see, but to me it's not as important as this stuff, so I want to make sure we at least get a problem. And again, it's just, you can read it as well as, and go through the PowerPoint as well as I can talk about it, so I'd rather work a couple problems. So on the big picture, we're going to talk, and then we'll sum up the big picture, which will also sum up the things that if we don't get a chance to talk about. But I love this big picture because this poor woman. Okay, so Martha was nearing the end of a year she'd like to forget. So She loaned a friend money to enable her to start a business, and she made payments of $7,000, $1,000 of interest, and her friend unexpectedly died. So she, at the time of death, her friend was insolvent, and Martha's unable to collect the money. Last October, she invested $50,000 in stock in a project in a pharmaceutical company that previously had been profitable. The company lost a patent, declared bankruptcy, and she's notified that she can expect to receive nothing. Right? So she's on a roll. She owned and operated a bookstore as a sole proprietorship for the past 10 years. The bookstore had previously had profits, but due to a growth of online vendors, it sustained a substantial loss of $180,000. And then in September, a hurricane blew through and caused a large oak tree to blow over on her house. Removing the oak tree and making repairs was $32,000. She did receive a check from the insurance company for $32,000. The adjusted basis in her house was $280,000. And then finally, as if that wasn't enough, Martha purchased $20,000 of stock that she thought was Section 1244 stock. Unfortunately, the stock value began to decline soon after, and several months later, she sold it for $12,000. Can we help her? All right. Well, she has a lot of stuff going on in 1 year. It's a bad year. And unfortunately, look at, she believed it to be. Well, we're going to find out that there's a big difference between regular stock and Section 1244 stock, because Section 1244 stock can be deducted beyond the $3,000 capital loss. All right. So if it's not, then she has a problem. So this chapter is all about different types of bad debt, in case you didn't get that from like the 8 things that happened to this woman. So the first thing, and then we'll jump to the end. So if an accounts receivable arising from credit sales of goods or services becomes worthless, a bad debt is only going to be deducted or deduction is only permitted if the income arising is previously included in income. All right, so if you include an income and it becomes bad debt, then you can deduct it. No deduction is allowed if the taxpayer is cash basis, because obviously they haven't deducted it. So, yes.
So you have your allowances for bad debt, right? That comes out of your AR.
If you were doing that, yes.
If you were doing that, then you do not get a deduction, because theoretically you already deducted it for your net AR.
If you were doing it that way, but she's a cash taxpayer,
Yeah,
so she hasn't done anything. She hasn't included an income. So therefore, she hasn't included an income, she can't deduct anything. She cannot take a bad debt deduction.
But if your company was something that
If your company was a bigger company and she was not a cash basis, she was a accrual-based taxpayer, then she would. But most, when you're looking at this, cash-based taxpayers are not going to be able to take a type of bad debt deduction. All right, so let's go ahead. I'm going to take us to... All right, we're going to jump to here. Slowly. There we go. Okay, so the losses that we can typically take. So we went from bad debt, and we're going to talk about business. We'll go back to the business losses, because they are really business type losses, okay? These are losses of individuals. All right, so losses of individuals, only the following losses are deductible by individuals. Number 1, losses in a trade or business. All right, so those are the ones we just skimmed over that we'll go back to. Losses incurred in transactions entered for profit. So it doesn't have to be a trade or business, but it entered for profit. And then losses caused by fire, storm, shipwreck. Okay, in case you're shipwrecked. I just always love that one. Casualty or theft. Now, starting from 2018 to 2025, casualty and theft or losses are only deductible if in a federally declared area. So that is a change.
Wow.
Yes. So I noticed you guys, hopefully you're seeing all the wows like that are coming in there. I actually had a friend who sent me a text 2 days ago, and it said, listen, last year I owed money. If I wanted to, and I swear we talked about this in March, but he said, if I wanted to make sure I tried not to owe as much, do I increase my W-4 or decrease my deductions on my W-4? And my response to him was, first of all, you're probably too late because it's October and you only have 3 more paychecks. But secondly, I don't know what to even tell you. I said, I can tell you that you, first of all, you got to go down, not up. You want to go from 2 to 1 or 1 to 0. I said, but it's such a mess this year that I tried to explain just all the different changes he's going to go through. He's got 2 kids in college, so he doesn't get the child tax deduction, but he's going to lose the 4 exemptions, and his itemized deductions are going to come down, but he could get a higher standard deduction, but I don't think he was, I think because he itemizes. So I said, you could end up owing a lot more regardless, and it's before any of these other itemized deductions go in there. So if you want to try, go ahead, but you might be adjusting your W-4 and you're still going to get nailed. Or you might be adjusting your 4 and maybe you'll end up getting more money. I said, it is not just you making a change that's going to affect last year's taxes, because there's too many variables in the air for this year's taxes. And he responded and he just said, thanks. And I'm like, a lot more information than you wanted to know, wasn't it? And he's like, yes. So this is just another one of those. So it can't just be something where you had a tree fall on your house. So you had enough that you're going to claim that casualty. Now, I'll show you, and when we do itemized deductions, you'll see more where casualty can go on there. Now, it has to exceed insurance losses. Hang on, okay. It has to exceed insurance losses, so it depends if you have insurance, and a lot of times this doesn't even come into play. But now that doesn't matter. If you have a loss, and it's not in a federally declared disaster area, then that's not going to be deductible in this area anymore. Yeah.
So, I'm sorry, I want to make sure I wrap my head wrong. So, people who lost their houses due to the fires out west. Right?
Those are all federally declared disaster areas.
But I think the last flood we had, the state declared.
The state declared it, and the federal also declared it. Usually, a state's not going to declare it a disaster area unless the federal does, because they need the federal money. Things that aren't going to be declared will be a tornado going through an area. Several years ago, a tornado went through Sunset Hills over here and wiped out near South Tech and all that area. That was not a federal declared disaster area, but yet it wiped out a whole stream of houses right along, and businesses along Lindbergh and Watson Trail Park and all that. That was not a federally declared disaster. It was a tornado that kind of hopped and did some damage, but it was not a widespread tornado. So any of those that needed to declare a casualty on their taxes would now not be able to. Usually federal is going to be large. Okay, this hurricane, what was she, Florence?
Yeah.
She is. She's federal. Most hurricanes end up being federal. All right, so losses or damages to taxpayers that arise from it. The loss in the event is, once you identify it, it needs to be basically sudden, unexpected, and unusual, right? Which is also the definition usually that the federal government is looking at. Anything that's not treated as a casualty include things like insect damage and disease. Those are not unexpected, even though we might not like them, okay? So, for example, termites in your house, it is a casualty to us, but it's not a casualty loss. Definition of theft, okay, robbery, burglary, and embezzlement. It is not losing things, which I know that seems obvious, but to some people it's not. All right, so when is theft deductible? Yes.
Does that include, though, it has to be federally declared?
Not for theft. Casualty. It's casualty.
Just that.
All right, so casualty is the year it is sustained. So the year that the casualty is sustained, unless, which is going to be going forward, will always be, in a disaster area, the president can declare that you can take it back a year. So there has been some federal that has been close to the end of the tax year where they say you can go back and put it in a prior year. So you have to amend that tax return, but they allow you to take, so usually it's around that April time frame. So if you amend that tax return or put it on that tax return, it allows you to get the savings then versus having to wait until the next year to benefit from it. So it really does help those individuals in that time frame of March and April and May get the money then versus waiting a year for it. Theft has to be the year in which you discover it. Not the year that it necessarily happened, but when did you notice it happened? All right, depending on the type of theft that happens, sometimes you don't, I can't think of one off the top of my head, but think of something, you could be something that happens a couple years later. Especially, I'm trying to think of like my grandparents or something that might go missing and you didn't even realize it was, or something in a storage unit or something along that line.
Well, is Bernie Madoff embezzled for years?
That's, embezzlement there, exactly. All right. So if reasonable, if you think you're going to get full recovery, then you don't do any type of loss. You deduct it in the year of the settlement. If only partial recovery is expected, you deduct in the year of the loss amount not recovered. Remainder is deducted in the year of a settlement. All right?
Is that, oh, sorry.
Yeah, go ahead.
Is that in regards to like insurance or something?
Yes, yeah,
covering it?
yeah,
Okay.
exactly. So that's the full recovery. So if you think like, if you have good insurance and you think you're going to get everything back, then don't. And I've kind of said that so far this semester. If you think you're going to get it back, don't put anything on your insurance. Because if you do, same thing as here, then you have to declare the income. Tax on income coming in is always more than the deduction of the loss. So you don't want to have to do it that way. So if we look at what happened to Martha, the tree fell on her house. She had $7,000 that was not covered by insurance. So because the extent of the damage, the president had declared it a disaster area, so she had two options. She can put it on last year's tax return, in which she would have to amend it, or she can put it on her 2018 tax return when she files it next year. That's completely up to her. Depends on when does she want her money. Now, with it being October, and we're looking at this right now, there's a good chance she will get her money just as fast as if she waits and puts it on her 18. Because amended tax returns, a lot of times, are going to take you 12 plus weeks to get the money back. But that would be her choice. All right, the amount of loss and the deductibility depends on, is the loss non-personal or personal property? Is it partial or is it complete? All right, so theft or complete casualty, you're going to look at the fair market value. Does it equal 0? So afterwards, does the fair market value of your property equal 0? If it does, it's going to be the adjusted basis in the property minus any insurance proceeds. All right, that's going to be your loss.
So when you're, so let's say Hurricane Florence came through and it completely destroyed your house.
Right.
The house is worth 0, but the land's never really worth 0.
Then the house isn't worth 0. The land is part of the house. So it's not, your house is never worth 0.
Right. So the fair market value will never be 0. So
In that example, the fair market value is not 0. Right. It won't. Because your house includes your land.
Right. So it's,
Your house
can
would
never
not be fair market. Your house would not be 0.
So a house can never theoretically go down to complete.
It would not be.
It would always
Right.
partial.
Right.
But like a car could be, because the car really
Right.
could be completely.
And they might actually say the fair market value is 0 only because of they're going to declare it a complete loss, which is usually a benefit to you. And then you take the adjusted basis in the property. But the houses are usually looked at a little bit different from insurance companies. And then partial count, you're going to look at the decline in value or the adjusted basis value, less the insurance proceeds, if you got any. So look at an example. So business and production of income losses. So no insurance proceeds was received. The first one, the adjusted basis was $6,000. The before market value and the after was $8,000 and $5,000. So your loss is going to be $3,000. The next one, the adjusted basis was $6,000. But the fair market value before was $8,000 and after was $1,000. So we're going to go with the adjusted basis. All right. And then the last one, fair market value was 0, so you go with the adjusted basis, period. All right? So it wasn't a complete loss on the first one, but the fair market value, the difference there, you're going to go with the adjusted basis.
So that the complete loss is the adjusted basis.
Complete loss, you go with the adjusted basis.
The lesser of the two.
The lesser of the decline in value or less the, and then adjusted basis in the price. So theft or complete loss. So you're talking about the second one?
I'm just trying to get the rules straight. So if it is a complete loss.
If it's a complete loss, you go with the adjusted basis. So the
Otherwise,
third one,
The lesser of the two.
the lesser of the two. And the lesser of the two is $3,000 for the first, $6,000 for the second, and then the last one $6,000 because it was a complete loss. All right, so non-personal losses on business or royalty or rentals, the deduction is going to be for AGI. So that's your Schedule E and your Schedule C that we've touched on. So it's going to be for AGI, meaning it's going to happen on the first page of your 1040, not subject to any rules that I'm going to talk about in just a second, all right? You're basically going to take the loss either on the Schedule C or on the Schedule E. And the benefit of that is you get to take the complete loss. All right? Losses not connected with a business or rental or royalty is deducted from AGI. And those are your theft or securities, and they're not going to be subject to a 2% deduction of AGI. However, oh, I thought this was just going to, maybe it's on the, oh, it's on the next page. They are subject to what's called a floor. So there is a line on the Schedule A that is separate just for, and I handed out the Schedule A, that is just for casualty, theft, and losses. All right. Every casualty, theft, and loss is separate. So if you happened to have, in her case, the hurricane go through, and she had another casualty in the year, each one would be separate, and each one would be subject to a $100 floor by itself, and 10% of AGI. So they'd be separate individuals. You can't say, well, I had 2 casualties in the year, there's a $100 floor. No, they each get their own one. So they're generally deductible only if in that wonderful federally declared area. These losses are itemized deductions, and so it's going to be the decline, which we already talked about, and you got to make sure you look at any insurance proceeds.
What exactly is the floor per event?
It basically
Like
says
the
base. So
Okay.
so in that example, how much did she lose? The last one, they had a complete loss. So let's go with the one before. They lost $4,000. So instead of being able to deduct, oh no, in Martha's example, she lost $7,000.
Okay.
So she'd be able to deduct $6,900. $100 has to come out.
Okay.
Why? I can't give you an answer.
Is it
I
just
mean, to
like
me,
their
it's just
tax
dumb.
on it,
Right.
or
Well,
just their fee?
then it has to exceed 10% of AGI. So it's kind of like we haven't got to all the itemized deductions. There's a lot of this have to exceed. So she gets to deduct $7,000, $100 floor, take the $100 off, and then that $6,900 has to exceed 10% of her AGI.
So she has to make at least 69,000.
So she has to make $69,000, or she wouldn't deduct anything. And based on her year, I'm not sure she did. No, but anything over. So if she only made $20,000, then $2,000 she'd be able to deduct anything over $2,000. So she will probably be able to deduct it all because she had a horrible year.
If you make less money, you have to pay more taxes.
No, you deduct it. She's deducting this, not paying taxes on it.
Wait, I can do the math.
Where's
Okay.
these come from?
All right. All right, and so here it says if a taxpayer has both casualty loss and gain, as well as other losses, there is an exception that disallows the deduction for the personal casualty other than those in federally declared areas. And so there is a way in which you net all these wonderful things together. Now, this is a very unlucky person, okay? And I'm going to show you an example. But keep in mind that obviously this happens because they have these rules out here and they're giving us this example in the textbook. So this happens to individuals, and a lot of it probably depends on where you live and just different circumstances and things. I've never even done a casualty loss, let alone I have done a theft, but let alone have the example that you guys are going to see. I'm not going to read through this because, to be honest, when I read it like 5 times. When you see the example, it makes a lot more sense. Okay, so we're going to go to the example first. So Emmanuel had an AGI of 50,000. So first of all, I liked this example because I like it when they pick just something round. I always like to use round numbers. All right, he had 3 gains and losses based on things that happened. So casualty gain means that he lost something, but the insurance that he got back actually benefited him. And that does happen. I try to show my boys sometimes, like when you're driving through the perfect examples like this area in Afton where my mother-in-law used to live, you'll drive around and you'll see all these cute little gingerbread houses, and those are the ones that are brick with the garage in the basement. I just think they're adorable. And then all of a sudden you'll see this brand new siding house, and it's huge, next to these gingerbread houses. Well, that house burnt down, and then they got to build up a house. For exactly what Katie just said a few minutes ago. When a house burns down, if it's properly insured, okay, which is a big if, depending on who lives there and everything else that goes with it, you insure the house for the value usually above and beyond what you paid for the house. What you paid for the house includes the land. So therefore, when you buy a $250,000 house, 60-ish, depending on where you live, sometimes higher, sometimes lower, of that is land. So when your house burns down, your insurance is going to be for replacement, usually, value of a $250-ish thousand house. And depending on when you bought the house, it's gone up in value. So now your $250,000 house is worth $300,000, and when your house burns down, if completely, because it is better if it burns down completely, and sad as that is, but a partial loss is hard to, you get a check for $300,000. Well, you have your land. So you now have $300,000, lost all your memories, okay, but you now have $300,000 to build a house. So you see a beautiful house next to older houses. So that would be a gain. That could be a casualty gain, where your gain comes forward from the fact that you actually got more for what you had in it. So, personal casualty gain. Then they have a personal casualty loss in a non-federal disaster area. And then they have a personal casualty loss in a federal disaster area. All right. So we have one. Yes.
If non-federally declared disaster area, you can no longer claim that, though.
Wait. Okay? Just wait. All right. So the first thing we're going to do is we're going to go through and we can offset the non-federal disasters because we have to take the gain. All right? You have to do that. And we can offset the non-federal loss against the gain. You can offset the losses against the gain. So what we end up with is a casualty gain still of $500. If that was a casualty loss, we could not take it. But it's a gain, so we got to offset our gain against the loss. Okay? Now, we take that casualty gain, and we have a casualty loss from a federal area, and we can offset that gain against our loss. So in the end, we have a net loss of $8,500. So we did not actually have to use any of our gain. So this individual who ended up gaining had enough losses that he actually got to. Because now I don't know what happened to this individual. Obviously he had 2 non-federal and 1 federal. So there is a chance that the house and whatever, I said it was a house.
Storm, then a tornado,
Right.
a hurricane.
Something whipped through and really took him out, right? But and then the federal disaster obviously was something completely separate because it was its own little thing.
Well, so sometimes when it's a federal disaster, like, a hurricane comes through, everything's destroyed, people lose.
Right.
So if somebody steals your car,
That's theft.
so that's not considered
The-
federally declared. Just the damage done by the hurricane is the federally declared.
Right.
Okay.
Right. Well, it depends what happened. I mean, I can't tell you exactly what they do with the theft during my guess is that the insurance company would still consider that a
loss.
yeah, they consider a loss. I can't tell you for sure what insurance company would do with that one. So then what happens, and this is the part I was explaining without the tax form, is then you would go and on your itemized deductions, you would show that you have a casualty loss towards the bottom of the Schedule A, and you would have 10% of AGI. Their AGI was $50,000, which means $5,000, so $3,500 of it would be eligible for casualty loss minus 100 for the floor. So $3,400 of it would be eligible for deduction. Huh?
You have to deduct both the 10% and the 100?
Yes. Yep. Oh yeah, they like to get you on that one.
It's not fair. That was a hurricane.
Yep. So now, like I said, those kind of come through, and you never really. I wouldn't say they're common by any means, but at the same time, theft is, and it just depends on what kind of insurance do you have and that type of thing to whether or not your theft would be covered. The most common theft that I've seen that friends have honestly been the theft of a car, but that's usually been covered. So it just depends on the theft that you have. All right, R&D expenses. When I first read through this years ago, I remember thinking, well, who's going to have R&D? Small companies, Schedule Cs, they have their own research and development. Cost of the development of anything internal, experimental, formula, invention, similar property, improvement of an existing property, research and development costs, that's the definition of R&D.
That's important, because you do have,
Yes.
have something that's groundbreaking from the research and development. Some employee says, I'm gonna steal this and I'm gonna run on.
Well, think about how Google started. Two guys, right? And think about how some of, what was the other guy in there? Apple started in his garage, wasn't it?
Yep.
Yep.
Or
So,
Walt Disney too, I think.
so when you start and you have that small company and you're doing a Schedule C, that R&D does get in there. It depends on what you're doing. It just, you start a Schedule C and you're doing something that doesn't have research, which a lot of companies don't. You're a lawn mowing business or you're doing consulting on services that you already, great. But if you're in any type of product development or an idea generating firm, that's R&D. That is something that you need to be able, so you have three alternatives, all right? Expense in the year that you have it, which is the most common for a small company because usually that's the way they know how to keep track of it. You can defer and amortize over 60 months or you can capitalize as of right now. There's a tax credit for 20%. You're the reason we don't get through most of this stuff. You know that, right?
Stop with the question.
But I didn't think it could capitalize before.
Can you wait till we get through the sections? Okay. Tax credit of 20% of certain tax research and expenditures, depending on what they are, if they're experimental, is available. But that's a tax credit. We haven't got to that. That's our last chapter we do, is tax credits, all right? Under the new Tax Act, all right, research and expenditures have to be capitalized. They no longer, when we go back here, expensed in the year and deferred. It's important that all things that you could do are always mentioned, okay? You just got to let me keep talking, okay?
You can't capitalize until you're sure that the project's...
Hold on, okay? You always got to mention what's there because you got someone that's come in and you're doing their taxes and they've expensed in the year, which is very common. And now they come in and you're going to tell them research and must be capitalized and amortized after, notice the year though, 2021, not right now. This method is not always available, all right? You cannot always capitalize, but they're telling you you have to capitalize it. All right, so there's two other changes that could. First of all, capitalization occurs at the midpoint of the year when the expenses are paid, all right, rather than the month in which they first realize the benefits, which is how we used to do it. And second, the expenditures are amortized ratably over 5 years, 4 and is 15, rather than over a period of not less than 60 months. So the first one right there, capitalized over a midpoint of the first year they are paid. That is what a big change is. It's no longer once, it's in production, okay? So people can capitalize immediately when they start incurring the charges, which is completely different from how it used to be. This is tax, okay? This is not GAAP. And just like I used to say in financial accounting, or I still say in financial accounting, accounting law is not legal law. You don't put something on the financial statements until you have paid it or you've received it. You might be legally liable to pay it, but it doesn't hit those financial statements until you received it or you paid it. So you sign a contract, that's great, but there's no transaction from a financial standpoint. And they have a really hard time understanding that because they're like, but we signed a piece of paper. I said, yeah, but legally you might have to pay it back, but right now you don't have to. Tax-wise, this is not GAAP. Tax is not GAAP. Tax is tax. Tax is run by the IRS. It is not run by FASB. It is not run by GAAP. It is not run by IFRS. It is run by the IRS, which is controlled by the government, and the government has no control from that aspect over IFRS.
So when a company's doing their taxes, everything that they've expensed for
Might have to be flipped around.
They're going to have to capitalize it for their taxes.
Yes.
And then most likely immortalize it.
Right. And you got to remember that there are some changes. There's different things you do for GAAP, and that there's some companies that do LIFO only for tax purposes. If you're IFRS, you can't even do LIFO anymore.
I know, I like that one.
Right. So, but that doesn't mean they won't do it for tax, because it benefits them for tax purposes. So there's a lot of things not a lot, there's many things that you can do for tax that you can't do for GAAP. And so the adjustments just have to be made.
But it doesn't matter till 2021.
This one doesn't matter till 2021,
Moving on.
but you got to keep it in your head. Yep.
So when you capitalize it, because it's considered an asset, you're gonna pay taxes on it as,
The capitalize, it's going to reduce the value of your asset. All right, so excess business losses. So what does that mean? All right, if a non-corporate taxpayer has excess business losses for a year, it is not allowed to have that. So instead, it can carry them forward. So what do you mean? So more than the $3,000, we can carry those losses forward. All right, and we can treat them as part of what's called a taxpayer's non-operating loss carry forward in subsequent years. An excessive business loss is defined as, and it gives us the aggregate deductions for the years attributed to the taxpayer's business, less the aggregate's gross income, and then there's a couple thresholds. So we have married filing jointly or individually. And then they have some limits based on the income that can be sheltered as a result of business losses to make sure that that's not happened. And this is on excessive business losses still. And this applies to aggregate gross income. So we're looking at married filing jointly. All the couple's trade or businesses must be consolidated. If we're looking at business losses from a couple, we have to look at all their have to be combined together. The losses of one spouse can be used to offset the losses of another spouse. So if you have two spouses who are both have business losses, you can offset their income together for the losses. Now this is not the $3,000. This is the bigger amount. So this is not capital losses. This is business losses. S corps we haven't got into. If you haven't taken survey business taxes and talked at all about S corps, but S corps is a very small company. It's 100 shareholders or less, where husband and wife are actually counted as individual shareholders. We'll talk a little bit more in Chapter 11 about excessive business losses applied for passive activities. So net operating losses from any one year can be offset against taxable income from other years. The net operating loss is intended as a form of relief for businesses. Okay, so only losses from trade or businesses and casualty, theft, or losses can be operating losses.
How far back does it go? Is it
Great question that you asked that. So,
that's a great question.
Kid-
I need to shut up.
well, that was her second question today. I lost track of your question. It could be, and your questions always come like a slide before I'm going to talk about what you're trying to say, but about. All right, so carry forward. In general, operating losses could be carried forward indefinitely before. But now, see, you didn't ask that question, Katie. That would have been where you'd ask about. But now they can't be. All right, they can be carried back 2 years and forward 20. 20. But they used to be indefinitely. Now they're just 20. So it's a long time. You might want to make sure you keep the same tax accountant. But back 2. Now, in order to carry back, you have to obviously amend those. If you have a loss, you want to go backwards, you have to amend. But usually you're going to amend because it's worth amending. All right. The net operating deduction in general is limited to 80% of taxable income, determined without regard to the deduction itself, just 80% of taxable income. All right. The carryover is less the computed limitation. So one of the examples we're going to go to in a second is with operating loss. All right. It's that, and it's going to be the operating loss, and it's also going to be with the casualty loss.
Okay, so you have a business that operated at a loss. I'm confused for a second.
Okay.
So I'm so confused. I can't.
Well, let's go through and see if, when we go through this, and see the example on here, if that helps. Because we're not going.
Is this for or from AGI?
This right here,
Yeah.
it's 4. All right, so operating losses and qualified business income, the deduction for qualified will not create or increase a net operating loss. So qualified business income. So these are carried over separately, and they will only, operating for qualified business income will only stay with qualified business income. We haven't really even talked about qualified business income. Self-employment taxes, an operating loss cannot be used to reduce self-employment taxes. Right? So that's, you cannot do that. Here are, this is small, but this is in your book also. So your taxable income shown on your return, computation of net operating loss. You're going to take your taxable income, and then you're going to add back in any exemptions. You're going to add back in any operating loss from carryover from a year before. Any qualified business income, if it was added in, you got to add that back. Got air flowing right at me standing here. Any non-capital losses over business gains, so more losses. Excess business deductions over business gains, and then excess business losses over capital gains. And then that is going to give you your net operating loss going forward. All right, now, there's 2 more slides. The effect of a net operating loss in a carry forward year. The taxable income and the income tax for the year is determined by including the operating loss as a deduction for AGI. All right. So the taxable income, we're going to figure that out. The computation I just showed you, and the income tax for the year is determined by including net operating loss as a deduction for AGI. Several deductions, such as medical expenses and charitable deductions, are based on AGI. So these deductions must be determined on the basis of AGI after that operating loss has been applied. So you got to make sure you got that net operating loss first, which we haven't talked about those deductions yet, because that's why we're talking about this stuff first. And finally, calculating the remaining net operating loss after carryovers. After you have that initial net operating loss, the taxpayer must then determine how much remains to take to the rest of the years.
So you would divide it by the 20 ideally?
Ideally, or what happens is you get to figure out that would be called like weighted average, right? Or that would be called straight line. No, what we have to do, unfortunately, is every year you get to figure out how much you can take. It's a matter of what you can take every year. So you might be able to take more in one year than you can in another. So let's look at what her deal is, and then we'll look at the problems. So bad debt, we already talked about that one. The loss from investments, I kind of led to this one on the first screen. Her $60,000 loss in deductible as a long-term capital loss, $50,000, sorry, I can't see very well. The holding period was not greater than a year, but she thought she purchased, I told you, the Section 1244, but it wasn't. So that $8,000 loss that she has is actually going to be a short term on the stock. She didn't hold it long enough. So she's going to have a result of that. The one above, the $50,000, that loss on that was a business loss, if I remember correctly. I can't remember what she did with the $50,000. The company went bankrupt. That is a 1244, and that's an ordinary loss, and that would be treated as a business loss. So the $50,000 is a capital loss, and the $8,000 is a short-term capital loss, but it's not Section 1244.
Where did the $8,000 come from?
That was the stock she bought from a friend. It was more than $8,000, but yeah, it went down drastically. Yeah.
So essentially because that company went under, that's why it's treated specially?
Well, it was a business. She invested in it, and this is the business. Was there something else? She invested in a business too. Is that it? Because this is her bookstore.
Well, she invested in her friend's business, but that's her friend. Nobody cares.
Right.
Friends don't count for nothing.
No. What was the $50,000? Did you have it printed?
Yeah, the $50,000 was what she invested in pharmaceuticals.
Oh, that was a pharmaceutical company. Because she invested though in a company, it's a business loss.
Not her friend. It was just a friend.
That was just a friend. You're out money.
was out,
Unfortunately, if you
yeah.
invest in a friend, you're investing in a friend, not a business. There, she invested in a pharmaceutical company. The company went under. It's a business loss.
So the other stock was that was in a company too, though. Wasn't
It was in a company, but it was just a normal company, just like you and I, and that's just a capital loss that you cannot exceed $3,000 in a year.
And it just went down.
It just went down.
It didn't completely go
No,
under.
no. All right, the loss in the bookstore is going to be reported on the Schedule C because that was her business, okay? And it's an ordinary loss, and it qualifies for the net operating loss that we were just talking about, all right? Martha can carry forward the $180,000 loss and offset it against future taxable income. However, it's going to be limited against that 80% of whatever her taxable income is. This year, I don't think she has any taxable income. I'm not sure, but that would be what she has. So, and then the casualty loss we already talked about. So, while Katie asked this question, I will hand out There's two questions, one on each side. We're gonna do the one on, question one on the first side first.